You're sitting at your desk on a Tuesday afternoon. The fluorescent lights hum above you. Your phone buzzes with the notification from your 401k provider. You open it. The balance has gone up. Not dramatically, but it's up. For a moment, you feel like you're doing something right, like you're building towards something. You close the app and get back to work. And somewhere in the back of your mind, there's this quiet belief that if you just keep contributing, keep doing what you're supposed to do, you'll be okay when you're 65. But here's what most people don't realize. According to recent Vanguard data, the median 401k balance for people in their 50s is under 6 figures. Not the average, the median. Half of people approaching retirement have less than that. And when you run the math on what that actually buys you in retirement income, it's roughly $200 to $250 a month using the standard 4% withdrawal rule. That's not a retirement, that's a car payment. So the question isn't whether your 401k is growing. The question is whether it's growing fast enough to do what you think it's going to do. And for most people, the answer is no. Not because they're doing something wrong, but because the system was never designed to make wage earners wealthy. It was designed to supplement pensions, not fully replace them. Let's start with what we've been told. For the last 40 years, the message has been simple. Contribute to your 401k, get the match, let compound interest work its magic, and you'll retire comfortably. The financial media runs headlines about millionaires who maxed out their 401ks every year. Retirement calculators show you graphs that curve upward like hockey sticks. The implicit promise is this: if you just save enough, invest consistently, and stay disciplined, you'll be fine. But when you look at the actual data, something doesn't add up. According to the Federal Reserve's Survey of Consumer Finances, the median retirement account balance for all U.S. households is around $27,000. That includes households with no retirement account at all. For households aged 55 to 64, it's closer to $185,000. And remember, that's household, not individual. If there are 2 people in that household, you're splitting that number. If you're single, you're carrying the full weight alone. Now, $185,000 sounds like a lot of money until you realize what it actually does. Using the 4% rule, which is the standard safe withdrawal rate financial planners use, that gives you about $7,400 a year, or roughly $617 a month. Add in Social Security, and for the median earner, that brings you to around $2,200 a month in total retirement income. The median asking rent nationally is somewhere around $1,600 to $1,800 a month. You see the problem. So how did we get here? The 401k wasn't originally designed to be the primary retirement vehicle for American workers. It was created in 1978 as a tax loophole for high earners to defer income. A benefits consultant named Ted Benna figured out how to use Section 401k of the tax code to let employees contribute pre-tax dollars, and employers loved it because it was cheaper than funding traditional pensions. Within a decade, pensions started disappearing. Companies shifted the risk from themselves to employees. Instead of guaranteeing a lifetime income, they gave workers a tax-advantaged account and said, "Good luck." The difference is profound. A pension was a promise. You worked for 30 years, and the company paid you a percentage of your salary for the rest of your life. The company managed the investments. The company took the risk. If the market crashed, that was their problem, not yours. A 401k is a bet. You contribute what you can afford. You pick investments from a menu you probably don't fully understand. You hope the market goes up more than it goes down. And if you retire during a downturn, or if you didn't contribute enough, or if life got in the way and you had to pull money out early, that's on you. Both things can be true at the same time. The stock market can hit all-time highs, and the median worker can still be nowhere near ready for retirement.
Let's talk about why that happens. The first issue is contribution rates. According to Vanguard's How America Saves report, the median employee contribution rate is around 7% of salary. Add in a typical employer match of 3 to 4%, and you're looking at a total contribution rate of about 10 to 11%. Financial advisors generally recommend saving 15 to 20% of your income for retirement. So right out of the gate, most people are undersaving by about half. But here's the thing. It's not because people don't want to save more, it's because they can't. Let's walk through the math. The median household income in the U.S. is roughly $75,000 a year. After federal and state taxes, Social Security and Medicare, take-home pay is around $57,000. That's about $4,750 a month. Now let's subtract the basics. Median rent or mortgage payment, $1,700. Utilities, phone, internet, $300. Car payment or transportation, $500. Car insurance, $150. Gas, $200. Groceries, $600. Health insurance premiums, $400. Out-of-pocket medical costs, $200. We're at $4,050, and we haven't touched student loans, credit card debt, childcare, clothing, household maintenance, or anything that makes life livable. You've got $700 left, and you're supposed to save 15% of your gross income, which is $937 a month, just for retirement, not for an emergency fund, not for your kids' college, not for a down payment, just for retirement. You see the bind. But here's where it gets interesting. Even if you do manage to save consistently, even if you hit that 10% or 12% contribution rate, the math still doesn't get you where you think it will. Let's say you're 30 years old, you earn $75,000 a year, you contribute 10% to your 401k, which is $7,500 annually. Your employer matches 4%, so that's another $3,000. Total annual contribution, $10,500. You invest in a diversified portfolio. Historically, the stock market returns about 10% annually before inflation. After inflation, that's closer to 7% real return. Let's use 7%. You do this for 35 years until you're 65. Your 401k balance at retirement, around $1.45 million. That sounds incredible. That sounds like wealth. You did everything right, and you're a millionaire. But here's what that actually means. Using the 4% rule, you can withdraw $58,000 a year before taxes. If you're in a 15% effective tax bracket in retirement, that's about
$49,300 a year.
After tax,
$4,100 per year.
Add in Social Security, and you're at maybe $5,500 a month total. Now remember, you were earning $75,000 a year during your working life. That's $6,225 gross, or about $4,750 take-home. Your retirement income is close to what you were living on, but not quite. And that's if everything goes perfectly. No market crashes at the wrong time, no medical emergencies, no early withdrawals, no periods of unemployment where you had to stop contributing. That's the best case scenario, and it gets you to roughly the same standard of living you had while working. Not wealth, replacement. Now let's talk about what happens when things don't go perfectly. According to research from the Employee Benefit Research Institute, about 40% of 401k participants take an early withdrawal or loan from their account at some point. The reasons are predictable: medical bills, job loss, emergency car repairs, helping a family member, life. When you withdraw early, you pay income tax on the amount plus a 10% penalty. So if you pull out $10,000, you might net $6,800 after taxes and penalties. And that $10,000, if left invested for 20 years at 7% annual growth, would have become about $39,000. You gave up $39,000 in future value to solve a $10,000 problem today. Not because you were irresponsible, because you didn't have another option. This is the hidden cost of living without margin. Margin is the space between what you earn and what you need to survive. It's financial oxygen. When you have it, you can weather shocks, you can invest, you can make long-term decisions. When you don't, every unexpected expense becomes a retirement setback. And for most people, margin has been shrinking for decades.
Let's zoom out and look at why. Housing costs have increased faster than wages. According to the Census Bureau, the median rent has gone up roughly 30% over the last decade, while median wages have increased about 20%. For homeowners, median home prices have increased even faster, roughly 40 to 50% depending on the market. Healthcare costs have risen. Even with employer-sponsored insurance, the average worker is paying more in premiums and deductibles than they were 10 years ago. According to the Kaiser Family Foundation, the average annual premium for family coverage is now over $23,000, with workers contributing around $6,500 of that. Childcare costs have risen. The Department of Labor estimates that infant care costs more annually than in-state college tuition in most states. Student loan debt has risen. The average borrower now carries about $37,000 in federal student loans, with monthly payments often ranging from $300 to $500. Car prices have risen. The average new car is now over $48,000. Even used cars, which used to be the budget option, are averaging close to $27,000. Meanwhile, wage growth has been modest. Real wages, adjusted for inflation, have increased, but not at the same pace as these core expenses. The result is that the same paycheck buys less flexibility than it used to. And when you have less flexibility, you have less ability to save. When you have less ability to save, your 401k grows slower. When your 401k grows slower, the gap between what you'll have and what you'll need gets wider. Now, some people are doing fine. Let's be clear about that. If you're a high earner, if you work in tech or finance or medicine, if you're maxing out your 401k every year, if you own a home in an appreciating market, the system works pretty well for you. You have margin. You can absorb shocks. Your 401k is supplementing other wealth-building mechanisms like home equity and taxable investment accounts. But that's not most people. According to the Social Security Administration, about 50% of American workers earn less than $45,000 a year. For them, contributing even 6% to a 401k is a significant stretch, and even if they do, the absolute dollar amounts are small. 6% of $45,000 is $2,700 a year. Over 35 years at 7% growth, that's about $373,000. Which sounds like a lot until you realize it generates about $1,200 a month in retirement income before taxes. That's not wealth, that's survival income, and it assumes no early withdrawals, no periods of unemployment, no market downturns at retirement. Both things can be true at the same time. The stock market can create enormous wealth for people who already have capital, and the 401k system can fail to provide security for people who depend on wages. So what does this mean for you? If you're behind the median, if your 401k balance feels small, if you've had to take money out or pause contributions, you're not failing. You're navigating a system that was never designed to handle the financial reality you're living in. The fact that you're contributing at all means you're doing more than half of American workers. If you're ahead of the median, if you're contributing 10% or 15% or more, if you're stressed about whether it's enough, the stress is rational, because even disciplined saving doesn't guarantee the outcome you've been promised. The math is just harder than the headlines suggest. You're not crazy. The system is just not built the way you think it is.
But here's where it gets interesting. The 401k isn't useless. It's still one of the best tools available for tax-advantaged growth. The employer match is free money. The tax deferral is valuable. And compound growth, even modest compound growth, is better than nothing. The mistake is thinking it's enough on its own. Retirement security, for most people, isn't going to come from one account. It's going to come from a combination of things: 401k, Social Security, home equity if you own, maybe a side income stream or part-time work in early retirement, maybe adult children who can help, maybe downsizing or relocating to a lower-cost area. That's not the narrative we were sold, but it's the reality. And once you accept that, you can start making decisions that actually fit your situation instead of chasing an ideal that doesn't exist. So what do you actually do? First, contribute enough to get the full employer match. That's a 100% return on your money. There's no other investment that does that. If your employer matches 4%, contribute 4%, even if it's tight, even if it hurts a little. That's the floor. Second, focus on margin before aggressive saving. I know that sounds counterintuitive, but if you're living paycheck to paycheck, if you have no emergency fund, if every unexpected expense forces you into debt, then increasing your 401k contribution from 6% to 10% might actually make things worse. You'll end up borrowing on credit cards at 22% interest to cover emergencies, which negates any growth your 401k generates. Build $1,000 in cash first, then $2,000, then a month of expenses. Create breathing room, then increase retirement contributions. Third, look at the full picture. If you're renting and rent is eating 40% of your income, your biggest financial lever might not be your 401k. It might be relocating to a lower-cost area, or finding a higher-paying job, or getting a roommate, or negotiating remote work so you can move somewhere cheaper. If you're paying $800 a month on a car loan, your biggest lever might be selling it and buying something used for cash. If you're carrying $15,000 in credit card debt at 24% interest, your biggest lever might be paying that off before increasing retirement contributions. Financial advice that ignores context is just noise. Your situation is specific. Your constraints are real. Make decisions that increase your margin first, then optimize for growth. The 401k won't make you rich. It was never supposed to. It was supposed to supplement a pension, which you probably don't have. It was supposed to be part of a three-legged stool: pension, Social Security, personal savings. But one leg is gone, one leg is shaky, and the third leg is carrying weight it was never designed to bear. That's not your fault, but it is your reality. And the sooner you stop expecting the 401k to be something it isn't, the sooner you can build a financial plan that actually fits the life you're living. You're not behind because you're lazy. You're not struggling because you're bad with money. You're navigating an economy where wages haven't kept pace with costs, where retirement risk has been shifted from institutions to individuals, and where the margin between earning and surviving has been squeezed thinner than it's been in generations. But you're still here. You're still trying, and that matters. If this resonated with you, subscribe. I break down the financial mechanisms that shape your life without the hype, without the fear, and without pretending the game is simpler than it is. You're doing better than you think. Keep going.